everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Let's do a little post-election, post-Fed look at Treasuries. And there's no doubt last week was chock full of headline-making events, to say the least. And typically, an FOMC meeting would take center stage, but when you have a presidential election day occurring in the same time frame, Powell & Company took a back seat this time around. But that being said, both of these events deserve their due course. And that's what I wanted to do this week in this podcast, talk about in terms of how they impact both of these events, the U.S. Treasury market. And let's begin with the post-election part of the equation. And as I'm talking to you today, control of the House of Representatives had yet to be officially determined. But the money and bond markets, as well as the betting markets, were all assuming the Republicans would retain the majority. In other words, the red sweep would be the final outcome. Now, the Treasury market didn't wait for the final results, that's for sure, as the Trump trade was on full display in a knee-jerk response to the outcome of Election Day, with Treasury yields rising in a rather noticeable fashion. Matter of fact, the rise in the 10-year Treasury was just like 2016, where an increase of about 20 basis points occurred the day after the election. But you know something, there's one big difference. The Fed was raising rates back then, not cutting them. More on that in a little bit. But a great deal of attention was given to the potential negative effects of a red sweep on the budget deficit and the attendant increase in Treasury supply. But let's put it into some perspective, okay? Budget deficits and increased Treasury supply was going to occur no matter a red or a blue sweep. And a divided government would still mean baseline deficits approaching $2 trillion remaining the norm. Let me give you an illustration. Fiscal year 2024, the red ink total came in at $1.8 trillion. That's 8.1% higher than the fiscal 2023 deficit of $1.7 trillion. And with anxiety really surrounding the swelling deficits in Treasury supply, they're legitimate concerns. There's more to the story than these factors. You know, in the past, when the deficits and the required increase in Treasury supply have been contributing factors to rate trends, the factor usually served as more of a secondary or tertiary force. Macro and Fed policy backdrop are the primary drivers for rate trends, with deficits in supply essentially adding to or deleting from an existing trend. This is exactly the case this time around as well, because President-elect Trump's policies, they were viewed by the bond market as being more pro-growth and inflationary than what a blue sweep would have resulted in. And what's interesting, U.S. 2 and 10-year Treasury yields have fallen roughly 100 basis points 2 times in the last year, even when budget deficits were approaching $2 trillion and the market was dealing with record supply. You know, now, in my opinion, the Treasury market was going to move on from the election results and return their focus back to the macroeconomic data in the Fed. And early on, that's proven to be the case. You know, as I'm talking to you today, the 10-year yield essentially retraced most of the 20 basis point increase from the day after the election. So if you look at Monday before the election, Friday, pretty much unchanged in terms of yield. And that brings us back to the Fed, where the November FOMC meeting and accompanying Powell presser underscored that future policy decisions are going to remain highly data dependent and not influenced by the election results anytime soon. Remember, legislation needs to be passed first and actually implemented before you can make any kind of economic or inflation assessments. And as I talked to you about in my post-FOMC podcast last week, the December Fed gathering will be a live meeting where another quarter-point rate cut seems likely at this point, data permitting. So instead of focusing on how high the 10-year Treasury yield may be headed, I think the more pertinent question right now is whether it can go back down to where it was around mid-September. And unless the labor market data collapses, the answer, in my opinion, is no, with yields likely remaining elevated in the months ahead. So that's it for this week. Have a great rest of the week, everybody, and be well.